Einstein put it, everything should be made as simple as possible, but not simpler. It means stripping away unnecessary clutter and stripping a concept down to its absolute core without losing the critical details that make it true. Now, that being said, I want to share with you guys today the one ETF that consistently beats the market and makes your life a lot easier. Just dollar cost average into it. The Invesco S&P 500 Momentum ETF SPMO has quietly become one of the most powerful wealth building tools available to everyday investors. While the standard S&P 500 index funds are excellent, SPMO takes the same underlying elite universe of US large cap equities and injects it with a systematic growth engine, the momentum factor. The core philosophy behind momentum investing is simple but backed by decades of academic research. What has been winning tends to keep winning in the near to medium term. Here is exactly why SPMO makes a compelling case for being one of the best investments someone can make, along with the critical mechanisms that make it work. It is the ultimate self-cleaning machine. A standard S&P 500 index fund is market cap weighted, meaning it buys more of a company simply because it gets bigger. SPMO, however, selects the top 100 stocks from the S&P 500 that exhibit the highest momentum scores, which is based on price performance over the past year adjusted for volatility. Because the fund rebalances semi-annually every March and September, it acts as a self-correcting mechanism. See, in a secular bull market driven by technology and AI, it automatically concentrates heavily into the fast-moving market leaders. If the market dynamics rotate toward healthcare, financials, or industrials, the ETF systematically dumps the laggards at the next rebalance and loads up on the new leaders. You never have to guess which sector will dominate next. The fund figures this out for you. It's got unbeatable cost efficiency for alpha generation. Historically, capturing alpha, which means outperforming the broader market, required paying high fees to active mutual fund managers or hedge funds. SPMO completely disrupts this model. Here they feature SPMO metrics. The SPMO charges an expense ratio of 13 basis points, which is extremely low cost for a specialized strategy. Balancing schedule, it is semi-annual. It occurs third week of March and third week of September. The core holding count about 100 of the highest performing S&P 500 companies. Primary driver, pure capital appreciation rather than dividend income. For a nominal fee of just 13 cents for every $100 invested, you get a highly concentrated, institutional grade tactical strategy that consistently fights to outperform the benchmark index. It has high velocity performance. When the market is trending strongly upward, SPMO can look absolutely unstoppable because it skips the bottom 400 underperforming or staying stocks in the S&P 500. It captures the raw upside of the companies actually moving the needle. The behavioral catch. There is a catch. Momentum works beautifully until it doesn't. Like during sharp market regime changes, when the market suddenly shifts from growth to deep value, momentum can experience shift pullbacks before the next semi-annual rebalance can adjust the sales. Now, how to fit it into a long-term strategy? Because the SPMO naturally leans heavily into mega-cap growth and tech during strong market cycles, it works best under two specific portfolio blueprints. The core cellular. Using a broad market fund like a VTI or VOO for a 80% of a portfolio and using a SPMO for a 20% cellular tilt to aggressively boost overall returns. The yin and yang factor. Pairing SPMO with a dedicated small cap or large cap value fund. Because momentum and value are historically negatively correlated, when one slumps, the other usually thrives, creating an incredibly smooth, highly optimized equity curve over a 10 to 20 year horizon. The Invesco S&P 500 Momentum ETF against the gold standard S&P 500 ETF VOO. We are looking at a classic matchup. SPMO presents aggressive alpha generation versus the ultimate broad market anchor, while both draw from the exact same universe of elite US large cap companies. Their internal mechanics result in completely different risk, return, and exposure profiles. The performance, the alpha engine in action. Because the market has experienced an incredibly powerful AI and semiconductor-driven expansion, SPMO's systematic strategy has captured massive outperformance over the broader index. It has performed really good year to date. SPMO has charged ahead significantly, posting returns of over 21% compared to VOO's roughly of 8.4%. 1 year trailing total return, SPMO delivered an explosive 37.6%, vastly outpacing VOO's otherwise excellent 25.8%. The 10-year long-term track record over the past decade, SPMO has compounded at an annualized rate of 19.25% compared to VOO's 14.9%. To put that into perspective, a $10,000 investment made 10 years ago would have grown to roughly $43,800 in a VOO, but would be worth over $65,200 in SPMO. The SPMO sector concentration, where is located the top heaviness, tech and semi-ecosystem, make up for about 55%. Industrials, 12%. Communications, 8%. All other sectors combined, 25%. Because the tech has been the undisputed market leader, SPMO has automatically packed over 54% of its total assets into information technology. Its top individual positions reflect an incredibly aggressive, high conviction bet on modern computing infrastructure. Micron Technology, MU, sits near 10 to 11%, followed by Nvidia at 8.5% and Broadcom at 6.8%. In VOO, the same megacap tech stocks are heavily weighted but they are diluted by hundreds slower moving healthcare, utility, financial, and consumer staple giants. SPMO, despite its greatness, comes with drawdown risks and volatility. You don't get 19% annualized returns without paying a toll and volatility. The risk metric SPMO versus VOO. Standard deviation over the past 10 years, 20.1. It's got a higher price swings against the 17% of VOO that presents a smoother ride. Drawdown 30.9% versus 34%. The Sharpe ratio, which is risk adjusted, 0.97 versus 0.90. While their historical maximum drawdowns during the 2020 crash were relatively similar to the day-to-day volatility of SPMO, is notably higher due to its 100 stock limitation and massive tech concentration. If the semiconductor sector faces a sudden correction or cyclical slowdown, SPMO will absorb a direct hit, whereas VOO's broader safety net will cushion the blow. However, because SPMO's rules-based approach allows it to switch gears during its semi-annual rebalances, its risk-adjusted return, the Sharpe ratio, remains superior to VOO's over long horizons. The systematic outperformance of the Invesco S&P 500 Momentum ETF over a regular S&P 500 fund isn't luck or a temporary anomaly. It is the result of a deliberate, rules-based design engineered to exploit a well-documented market anomaly. Academic finance has studied this for decades, while standard economic theory says the market should be perfectly efficient. The momentum factor consistently beats the market over long time horizons. SPMO achieves this sustained edge throughout four specific mechanical advantages over a traditional index fund like VOO. A standard S&P 500 ETF is bound by its mandate to hold all 500 companies. It forces you to own the stagnant giants, the dying business models, and the companies undergoing structural declines. SPMO cuts away that weight. By strictly limiting itself to the top 100 stocks with the highest momentum scores, it creates a concentrated portfolio of companies whose earnings, revenue, and price action are actively expanding. It lets you completely bypass the lower 80% of the market that acts as a performance anchor on the regular index. AT exploits human psychology and behavioral bias. Momentum works because human beings drive the stock market and human behavior is highly predictable. Institutional outperformance happens due to two core biases. The anchoring bias: when a company releases a blowout earnings report, Wall Street analysts and investors are naturally conservative. They adjust their price targets upward too slowly, meaning the stock price takes months to fully reflect its true new value. Momentum rides this multi-month wave, the bandwagon effect, FOMO. Once a clear trend is established, massive institutional inflows, mutual funds, and retail investors pile into the winners, creating a self-fulfilling upward cycle that can last for quarters or years. It has asymmetric weighting, high volatility protection. SPMO's secret weapon is how it weights its top holdings. It doesn't just look at pure price appreciation. Its formula calculates a stock's volatility adjusted momentum. If a stock skyrocketed 50%, but did so with wild, erratic daily swings, SPMO penalizes it with its score. If a stock climbed 40% in a smooth, steady, predictable uptrend, it receives a much higher score and a larger weighting in the fund. This filters out unstable, speculative meme stocks and targets high-quality, institutional-grade trends like the massive computing and semiconductor build-out led by companies like Micron and Nvidia. They rebalance again every March and September. SPMO goes through a strict, emotionless rebalancing process. The semi-annual rebalance action takes place in March and September. The market leaders keep trending. Automatically maintained or increased sector rotations occur. Systematically liquidates old laggards and buys early stage new winners. This structural agility is why it keeps outperforming over long horizons. It acts as algorithmic trend follower. If the economic regime changes tomorrow and tech cools down while energy or industrials begin a massive multi-year bull run, SPMO will systematically dump tech and buy the new leaders at the very next rebalance window. Well, thank you very much for staying up until the end. I am heavily concentrated into SPMO. Like most of you guys that follow me already know, SPMO is a heavy portion of my portfolio, and I'm gonna keep DCAing into it. I hope this video was helpful. I hope you guys can look into SPMO and see if it fits your financial goals and objectives. If you have any questions, comments, feel free to reach out. I'm here for you guys. Peace out.